Welcome to Sir Lancelot's Real Estate Roundtable, your guide to mastering the realm of real estate in Central East Florida. I am Sir Lancelot Lenard, ready to uncover the secrets of seller strategies, home staging, mortgage mastery, and more. From Daytona Beach to Cocoa Beach, Lake County to St. Augustine, join me as we navigate the intricacies of real estate. As the leader of the Sir Lancelot Group at Florida Homes Realty and Mortgage, I'm here to arm you with knowledge and innovation, whether you're a seasoned homeowner or a first-time buyer, unveiling the kingdom of real estate, one roundtable at a time. Welcome back to the Real Estate Roundtable, where we bring you the strategies, stories, and secrets you need to win in today's competitive real estate market. Here's a question for you. What if the success of your next real estate move didn't come down to the house, but to the plan behind it? Today's guest is a powerhouse in wealth strategy, from trading in the Chicago Commodity Exchange to guiding families at Charles Schwab, and now as the founder of Core Wealth Consultants and creator of the PlanAssist framework. Tim Clifford, CFP, has spent decades helping high net worth families build diversity and protect their wealth. If you're a homeowner, investor, or someone trying to turn real estate into long-term freedom, you're about to get a masterclass. Timothy, welcome to the podcast.
Thank you. Thank you very much, Lancelot. Great to be on here. I appreciate you coming on or allowing me to come on.
Thank you for coming. Tim, your story begins on the trading floor in Chicago, a fast-paced, high-stakes world. Can you take us back to that moment? What did you learn there that shaped how you guide people today?
So I had left college after 2 years in college. I grew up in central Indiana, and I decided I wanted to figure out a way to make a lot of money. And back then, you didn't have online trading like you do now. You didn't have Bitcoin. You didn't have those kinds of things. Back then, if you wanted to make money investing, you had to go to Chicago or New York. That was it. And so I moved to Chicago, lived downtown Chicago, and started out at the bottom and worked my way up into trading and arbitrating and all that. And one of the things that I still really preciously remember is there was no funner job than that. Even all 30 years later, when I look back, that kind of 10 years of my life was no question the funnest 10 years of my life when it comes to working, because every day was just a blast. The problem was I got to be about 30 years old and I'm like, wait a second. I'm not building wealth. I'd make a lot of money, I'd lose a lot of money, make a lot of money, lose a lot of money. But at the end, my net worth wasn't increasing. And it became clear that wasn't going to be a way that I could actually build wealth. It was a great way to make a good living and have a lot of fun. And that wasn't what my goal was or my outcome. So I moved from the commodity business over to the stocks and bond business. And then I worked in the brokerage, stocks, bonds, working with clients and management, et cetera, with H&R Block Financial Advisors, Charles Schwab and Company, Ameriprise. And then I started my own business now. But when I go back to those days, my learning was trading is a very difficult way to make a living. And I can remember some of the old time traders saying trading is the hardest way to make an easy living. And I've never forgotten that. I moved from trying to do short-term trading to more investing, and that's worked much better.
Okay. So at some point, you shifted from Wall Street strategies to helping everyday families. What inspired that transition, and how did it lead you to create the Plan Assist framework?
So what led me was when I left the commodity business and went into the brokerage business, I needed to have some money because I hadn't saved any money. Even though I'd made a lot of money, I hadn't had any money. So I needed to go someplace that paid me a salary and gave me some kind of income and insurance and those kinds of things, because I had a little one and all that. So I went to Charles Schwab and Company, and it was one of the most growing periods from a financial perspective that I had because I worked at the Charles Schwab office in Indianapolis. And at Charles Schwab, we would open up 10 new accounts a day. People would just walk in, open an account. And so I got an opportunity to ask, what is it you do? How do you make your money? How do you make your investment decisions? And through that process, so I'm learning the brokerage business, the stocks and bond business, and I'm really servicing clients. I wasn't selling. That's one of the biggest challenges that happens in the financial services businesses is if you meet a lot of people that are my age, they don't really have the customer service experience. They primarily have spent their whole career selling. And so they don't really get into the depth of someone's like how they make an investment decisions, opening the different accounts and that kind of stuff. Where at Schwab we did. And so I learned how a lot of people with a lot of wealth saw their investments and managed their money. And so one of the more memorable times when I was at Schwab was we had one older gentleman who had the account was just absolutely gorgeous. If you looked at the list of investments that he had, I mean, he had all the good companies. He had Coca-Cola and Procter and Gamble and IBM and all these companies. And I can remember looking at that and saying, how did you build such a fantastic multi-million dollar portfolio? And he said he just used a really simple formula to pick the stocks that he bought. And then just over the years, that turned into a fantastic portfolio where he wasn't trading, he was just investing. And so that was my aha moment to say, hey, the way people with money invest differently than the people who don't have money. And that's where I came up with my three principles. They all have a plan, they're all diversified, or at least at some point in their investment careers, they might start off concentrated, but they'll end up diversified. And then lastly, they're fantastic at seeking counsel. That they're really good at asking questions. So it's not like seeking counsel where they sit down with a salesperson. They're just really good at calling their contacts and just saying, what do you think about this? And getting a clear view of best case, worst case scenario. I know that
Gotcha.
was a long answer, but
That's a good answer. Thank you for clarifying that. Let's dive into the framework. You just said have a plan, diversified, and seek counsel. Can you walk us through why those three principles matter so much, especially for people who have most of their wealth tied up in real estate?
before I even get to that question, I want to just point out a statistic that was shocking to me. When I
Okay.
was putting together some statistics, I'm constantly trying to review kind of where's people at and what's the market. And I came across a statistic that was really surprising, and I'll be curious to hear your kind of input on it. 18% of households in America have a net worth of over $1 million. Does that number surprise you?
Not really, because I listened to a lot of people. I think it's low a little bit. I thought it was
You
going to be
do?
higher. I thought it was going to be higher, but yeah, that's about normal. Look, how inflation happened with the housing market. Most people have most of their money in their houses. And let's say baby boomers, they bought their homes in the 60s or 70s for 50,000 or 60,000 or $80,000 that are worth now half a million, 600, 700,000, and with a paid off, no note on it anymore. So they have 700,000 right there, and they probably have some savings and some money put aside in a 401k, which would bump them up to $1 million, I would say, if they were smart with their money while they were working. And that's I see $1 million is fairly simple. I have it too. That's around where my net worth is right now.
So
So
that's the perfect answer because you're in real estate. You understood that. That was high to me. Okay. But to you, it's 18%. But here's the kicker. So then you dig into those numbers just a little bit and you really hit on it exactly what you just said. Only about 4%, actually, it's 3 to 4%. It depends on which statistic you look at, having net worth of $1 million minus their homes.
wow, yeah,
So to your point, exactly what you
yeah.
said,
So their home holds most of their net worth.
net worth. So you have roughly, say, 4% of people, households in America have a net worth of $1 million. 18% have a net worth of $1 million if you count their homes.
Wow. Wow, that's a big difference.
Yeah.
That's a big gap. That's a big gap. So how does that relate to our conversation here?
So,
Elaborate on
so,
that.
so here's what happens. So what happens is I'm a financial advisor, an RIA, and I basically get paid to help people with investments. All right. So if someone has $1 million, but all their money is tied up in their home, if the million, so they have a 401k and then they have 500,000 in equity in their home, and then maybe they got a little bit of money in a savings or brokerage account. They don't really have any money outside of those kind of two or three platforms. And so what happens is they, for the most part, goes to seek counsel. That's why I actually added it. For the most part, they don't usually work with financial advisors. Like you would be absolutely surprised. You may not be because you're in the business, but there's a lot of that 18% that have a net worth of $1 million that don't work with financial advisors for a variety of reasons. They don't have the money outside their house or their 401k. They don't trust financial advisors because they're doing sales or et cetera. And so what happened, this goes to answering your question. When I understood that, I'm like, well, what is it that rich that those households that I work with, what are some common principles that particular group has? And what I found was that group has a plan. They're diversified, not with their house. So they have 2 or 3 million outside of their house. That a lot of that group, they don't see their houses as an investment. They see their houses as just a place to live. And I think that's the single biggest difference between that 3 or 4% and that other 15%. That group that has most of their net worth in their houses, if you talk to them, they see that house as an investment. And so they sit down with someone like me, it gets real yucky quick because I'm like, your house isn't really worth anything because you have to live someplace, right?
It's
You're
like a
got
wash, basically.
it's a wash, right? I have 500,000 in my house. Yeah, but how do you that doesn't help you because if you sold that house for $800,000, you're not moving to a $200,000 house. Who's doing that? They'll say, "Oh yeah, I can do it." I said, "That doesn't happen. Once in a while it does. I don't want to say it never happens, but it's unusual."
Right.
And like what I try to really help people with is think of your house as just that. It's a house and it's a place to live in. And yeah, you can get an equity loan against it when you really need it, or use it as an emergency fund, or use it as it's still a really solid asset to have inside your financial plan. But your focus needs to be how do you build wealth outside that house equity?
So how do you build wealth outside the house equity?
Number one is that usually it's a retirement account, 401ks, but you need to do it max. You'd be very surprised how many people that work at Martin Marietta, as an example, that put 4% because that's the match. If you ask someone how much money do you put in your 401k, they say I put 8% because Martin Marietta matches half of it, or I put 4% because of whatever the match number is, but they're putting 3, 4, 5%. When in reality, they can put probably 30,000 or some number depending on kind
So
of where it
maxing
is.
out your 401k is a
Um,
good idea.
Definite. It should
Okay.
just be something you automatically do. Max out the 401k, and then you should also have an investment account outside of your 401k that you're contributing money to as well. Those two things are critical as ways to build wealth outside their houses. But it's hard. So it's easy for me to say, but hard to do because you get, what's the word? Once you get successful, you have a house that you want, right? And that house costs X. And then you can only afford so much money outside buying that house. So you have to live under your means basically to do those other two things.
Yeah,
You
and
could live in a much bigger house than what you make basically.
I totally agree with you. I listen to a lot of coaches and I talk about it every single time on my podcast, like Tony Robbins and all these guys. You shouldn't have your expenses of your house shouldn't be more than a quarter of your income. And then the rest you have 75% there, about 25% should be on living expenses and about 25% should be going to investments, you
I
know?
agree. That's right. I
And
agree.
so if you can, let's say, why jump from your $400,000 home where you're paying, let's say you got a good rate and everything locked in at $1,600, $1,700. Why would you jump from that and go into a giant house? Well, you could afford it. Yeah. On paper, you're good to get an $800,000 house. But now your monthly payments go from 16, 1700 to 4 grand or 5 grand. Why do that when you're comfortable and really good where you are? And then you could invest that difference
That's
into
right.
something that will generate you amazing returns. I'm not saying it's going to be constant, but it could be, how do you call, what's the term for compound interest for
Yeah.
one thing? You could get compounding on that, stay an extra 2 or 3 years in that smaller house and build some extra money on the side. So you have that for your retirement. That's my opinion. I don't know. What do you think about that? Is
I
that a
agree 100%.
you agree? Okay.
But even the opening up a brokerage account outside the 401k and starting investing, I tell like 25 and 30-year-olds that little exercise, even if you're only putting $500 a month or $1,000 a month, that is enough to make a massive difference in your net worth when you fast forward 30 years. And it's not the $500 a month, by the way. It's the learning to it's the learning to invest and seeing how that grows over time and goes down over time in times of stress, but then it comes back. That investing is an emotional process. There's nothing harder for me to do as a financial advisor than to help someone invest a big chunk of money. If someone inherits money, gets a settlement in a lawsuit, but they've never invested, that is literally the most difficult client, bar none, for a financial advisor. Someone who's invested a little bit over their whole lives, they know that that's a group that just keeps investing. You get them more aggressive, you get them less aggressive based on when they need money. You put together that goes to the plan piece. So it's how much liquidity do we need? How much are you going to spend this year that we need to pull out of the account? Next 5 years, 7 years, we put money in the long term money. The point becomes, I have a couple clients that have got a big chunk of money, and I tell them, you don't you don't have the luxury that I had. Okay. And what I mean by that is you starting off with a huge amount of money is one of your blessings and curses because what I did was started with 1,000 and then it turned into 10,000, then it turned into 20,000. Through that, all of a sudden my 5,000 turned into 4,000, turned into three, then went back to 6,000, went back to seven. But over the course of decades, I just watched it grow, watched companies go down, watched companies come back, right? So all of a sudden now I have multi-million dollar account with where now all of a sudden there's a big market correction and I lose two or $300,000. That's that, I'm not going to say that's not an issue, but that's normal. You can't not do that. That's part of investing. And it happens with real estate as well. You just don't see it. We're seeing your brokerage account, you see it.
Yeah. You physically
Right?
don't see the numbers go up and down.
That's right.
Yeah.
You don't get like this statement at the end of the month says, "Oh, your 100,000 is now 80. Oh my gosh, I just lost a half of a car."
You might get that email or might get that postcard from your realtor saying your new house value every month
That's right.
and how it changes,
But
but you're
that's
not
kind of
paying
new.
attention to it as much as you do to a brokerage account. I know myself, I check it every day. I'm
That's
looking
right.
at it and say, good, up and down and up, and now down 5,000, now up 10,000, now down 20. Holy cow, it's like a roller coaster.
Right.
But at
No,
the end of
that's
the
right.
day, you win most of the time if you invest in the right place.
But you have to get used to that roller coaster. That's not a good investor or a bad investor. That's an emotional side of the investing, right? And that's
Yeah,
probably 80% of the challenge. And that's why the plan becomes so important. Because if you have a plan, you build in knowing that there's going to be ups and downs, and you've already had that conversation, you've already seen it.
that's true. That's true. Just so you know, by the way, I used to be a financial advisor in Hungary. I don't know if my certifications would work here, but I always When I sat down with a client and we talked about this is your life insurance policy and it's going to yield you X amount of dollars in 14 years because it's an investment slash life insurance combo package. And the one thing that I always highlighted for them is like this money that you're going to put in, let it be $500 because we're talking about $500. It's a set it and forget it. It never existed on your account. So think about this auto draw. As soon as your paycheck comes in, it sucks it out. It was never there. And that thought that it was never there should start being engraved in you.
That's
Because if
right.
you think about the money, oh, that $500, I could use it right now to take the family to on a short weekend. No, that's not what that 500 is for. That's for your future. And that's the thought I think that everybody should utilize in their investments is, hey, if I have a $500 deduction a month towards my investment account, that money never existed in my account. I have to work with what I got. So if I make $5,000 a month and 500 gets sucked out, I have 4,500 left. And that's what my money is to work with. That's what I pay my mortgage with, my car payment, my house, my food, everything else. And if there's a little left over after my obligations, that's my play money. But that 500 is going to go towards my investment. And I don't think about it as, oh, I could use that 500 right now. No, don't. It's not what it's
Correct.
for. It's for your future. That's your future money.
The best way to think about it is you can tell if someone's really rich. Okay. If you have in just a very short time, if you're like just run into them at a cookout or something like that, people who manage have figured out a way to build a pretty substantial net worth or inherited a substantial net worth. Okay. They've disconnected their investments from life events, right? They don't see $100,000 in their brokerage account and think I could buy a car. They don't, those two are completely disconnected. In fact, in Paul Getty's diary, it's one of the most fascinating stories because when Getty, he was one of the richest men in the world back in I don't know, what, 1920s, something like that. And he has a diary. Back then, I don't know if people do it anymore, but back then the people kept diaries, right? And someone got a hold of his diary and they found the day that he'd sold one of his biggest companies in Texas. Became like it would be like Musk selling Tesla. It was just ridiculous the amount of
Mhm.
money he made. They went to his diary to see what he had put in his diary on that day. It wasn't even mentioned, Lancelot.
Wow.
And what it was in there was he was talking about how he saved money by changing people to buy the wheat or something in the household or something. It was like something to do with the running the house and managing the money in the house. That the becoming this multi millionaire wasn't even in his diary. And the point becomes, and this is takes it is you've got to disconnect your investment account from your cares. If you've been to Vegas, you know that the first thing they do is you start off with the red chips and okay, I'll do two. By the time you're in Vegas for 3 days, you're like using black chips, right? And you don't disconnect. One's $2 and one's $20 or whatever
Yeah.
color that. But all of a sudden you find yourself betting $20 a hand or $50 a hand when you just never would have done that naturally. That's why Vegas uses chips. I'm not saying investing gambling, but it's the same mental exercise you need to go through. Separate that investment account from daily activities.
Yeah. I have a technique for that when we go on cruises or Vegas. This is my budget. Let's say $200. That's all I get to play with. If I lose it, that's it, done. No more. If I win, let's say I double it, I take it out and I said, hey, babe, let's go to a nice restaurant because I want some money.
Yeah, that's
You get
what.
what I'm saying? The
No, right.
reward for doing that. But if I lose it, that's it. No more playing. And it's hard. And a lot of people have hard time because, oh, I could win that back. I could win back. No, you lost it. You lost it. You should not
Yeah,
worry about that. Just go on the next trip and then use it again and use another $200.
exactly.
That trip, that's done.
Yep.
So I had a question here. We just touched a little bit about majority of the net worth of the people are in their homes. So what's the danger in that? What are the smart ways to unlock flexibility without losing security? That's the about the equity in the home.
The danger is this with love or caring, but it's a reality. The danger is you live above your means because you think your net worth's higher than it really is. Your net worth really is $1 million. So you try to tell your significant other. A lot of families, a lot of households or couples, one person knows what the investments are, the other person knows very little. That's not really healthy, but that's the way it works. Okay. The person who knows very little sees that their net worth when they're doing a plan, or they see the house is worth $1 million and they don't know, they live past their means. And it's just natural. It's not like they're trying to be overly spending. They just naturally do it because they're like, heck, we can afford this car versus this car. We can afford this vacation versus this vacation. And because they're calculating the value of that house. And so their daily living expenses are, and their financial decisions and those types of things are based on that number. They're not, but in reality, that's probably not a real number. It is a real number on paper, but the ability to pull that number out and making it part of your living expenses is very difficult because it goes to my point. You got to live someplace.
Correct.
And you're not going to go down. So to your point about I have a $400,000 house, I'm going to go buy a $700,000. I can afford it. The minute you buy the $700,000 house, you're probably not going back to a 400.
That is so true, by the way, because you
Yeah.
always go up, unless you're retiring and you're like, okay, let's downsize it. But even then,
What
like
the
you and I
heck?
talked,
No
even
question.
that, we talked a little bit about before the podcast started. We talked about Margaritaville in my area. They're somewhere between four and seven or $800,000 homes, two bed, two bath. Let's say you're retiring in New York and you have an $800,000 house. You're going to sell your $800,000 house. You're going to come down here and buy a Margaritaville for $700,000 tutu. And you were selling your five bed, three bath house in upstate New York or something like that. And you're like, God, it's the same money for a much smaller home.
They're not going down. No one
No,
goes
they're
down.
not. It's
I,
insane.
I live in one of those neighborhoods that's like Celebration. So it's a bunch
Yeah.
of million
Oh, I love
dollar,
Celebration.
$2 million. Yeah, the neighborhood I live in is Oak Park, Oakland, but it's very similar. And I'm telling you, you wouldn't believe how many of those homes are people from up north, people down in Windermere. They move up here and they're buying these homes, and it's two people, and it's 3,000 square feet,
Yeah.
and it's a million, $2 million home. I'm just like, what are they doing?
Why do they need that space? What do they need it
Correct.
for?
Now I
Collect
don't
more
know
stuff.
if that in a perfect world, I've seen all kinds of data points on this, but I'm not sure that, again, this is more art than science. So it's more like your situation, your specific kind of where you're at. But you really want to have your house almost like a non event in your financial life,
Oh. We,
right?
as realtors, we speak about the largest event in your life, as in purchasing your home. That's your biggest purchase in your life.
But the top 1%, that is not true.
No. Okay.
Even the top 5%. If you take the top 5% of people that have net worths of three, four, $5 million, and you get in a conversation with them, the house is it's almost okay. I got to live someplace. That's where I live.
Yeah.
And it's a very small portion of their total overall net worth. Someone with $3 or $4 million, it's not uncommon for them to live in a $500,000 home. $700,000 house, right? Especially if they've built that net worth. But that's probably the right ratio. That is probably the actual number. It's probably 20% in a perfect world that your house is worth, 25% max. And then all the rest of it needs to be in investments of some sort.
That makes a lot of sense. And that gives you exponential growth throughout the future. Because let's say you have $1 million net worth, you're living in a 200,000, you bought your house for 200,000, let's say, and
That's
then
right.
your portfolio became $1 million. Okay, now you're at your 20%. You have 800K working for you,
That's right.
which if you look at a 20% average growth on something like $800,000, that's $160,000 a year in growth. That is achievable. If you do conservative at 10%, so $80,000 growth a year. Now, in 5 years, that portfolio,
Is a
uh,
million plus.
it's a million plus. Yes,
Yeah.
you're in the 1.2, $1.3 million ballpark in 5 years. In 10 years, you're almost at 1.8, 1.9, almost $2 million.
And your
So,
house is still
and
worth
your
a
house,
million,
it's
right?
still
By
going
now.
up. Yeah, the
That's
house
right.
is still appreciating.
That's
But
right.
it's so hard though. Have you thought about it? And nowadays, a regular, because I live in a 4-2, it's a normal house. I live in a decent neighborhood in Port Orange, but I bought my house for 330,000, if I remember correctly, in 2022, and now it's worth 450. But it was my net worth wasn't. It was way off. My net worth grew in 2022, 2023, 2024. That's where I made most of my money. But I am currently, my house is 45% of my net worth. So it's off balance. But you
Yeah.
can't get a home nowadays that is in a decent neighborhood with somewhat of a nicer amenities. And this is a simple home. I'm not saying that we're living in a fancy castle or something like that. You could get a mansion in Texas for this price. It's a simple working class neighborhood, but these are the numbers now. So,
Yeah, but you're still in really good shape.
oh yeah,
45% is very different than you'd be surprised. As young as you are, at least you're on the right trajectory, right? You don't upgrade your house, you keep adding some money to the house. The house still goes up. So the example you gave, now instead of being worth $1 million and $100,000 outside your house, you're worth 2 million, and maybe the house is worth 1 million or 800,000, right? Fast forward 10 years, but
yeah,
you got 1 million, 2 or 3 million outside the house.
correct. My age is de facto here. Like I'm under 40. I
Correct.
still have a lot of long ways to go till retirement to
That's right.
65. So that it's going to change as it grows, like the initial investment of the house and the portfolio as it grows. That's definitely going to shape up differently. So that second part of that question was, what's a smart way to unlock flexibility without losing security in your home?
I think what you're doing is the way. There's no simple way to unlock it. You can't just you go get a second mortgage or something like that. You've just added risk. There's no really simple way to do it. You have to just
Go and grind.
underbuy your house. You have to get contentment and under buy your house based on your income. And there's probably no secret way to do it. And if someone says there is, it probably goes with risk.
This was one of the things we were approved for $450,000 when we were looking for houses. I told my wife, we don't need a $450,000 house. This house that we found where we live was perfectly fine. It was $330,000. I said, why go and buy the fancy for it? Because there were options out there we were looking at, like, oh, look at this nice house, tile roof, and nicer community, really cool finishes on the inside, nice floors and all that. And I'm like, do we really need that? No. Do we really
Correct.
need that? No, we don't. Plus, the location was like, we didn't like the location of it as much as we like the location of where we live right now. And I'm like, we could get a similar house and we could update the inside to where we want to update it to. Especially me being a contractor now, I can go in and change the kitchen if I want, or
Yeah,
do the
exactly.
changes I want to make it the way I want it to be. But the point was that we don't need to spend all this money. What are our payments here, and what are our payments here? My mortgage is $1,600 a month. I'm like, you can't beat that.
The
You know,
correct.
my I think if I look at the grand scheme of things and my average income, I'm probably at 16% of my income for the house payment, which is amazing.
It's
Under 20%. And that's what
that's
I
the
look
goal.
at. That's what I look at. It's like it's not 20% of my portfolio as a net worth, but it's
Right.
under 20% of my monthly income payments, you
That's
know?
right.
So I feel comfortable with it. And I know I could easily swing that even if there's a downturn or something and I have to go to work at Home Depot or whatever. I can still manage to pay that if I need to.
That's correct.
Like if everything crumbles in my business world, I can still find a job that I can afford to pay my house and I don't have to sell it, which is good.
And what that does for you mentally is it gives you confidence to try stuff, to do YouTubes like this, to do,
Yeah.
if you're constantly behind where you got to generate X number of dollars and you over buy in your house, if you do that when you're your age, it's hard to get back down into a house that you really can afford. So there is just, again, I go back to there's no secret. It's you just need to live in a house that's probably smaller than you can afford.
It's yeah, not meaning small, but lesser expensive. Let's say that because
Yeah, exactly.
size
That's
is
what I
not the
mean.
thing. Because
No, it's
let's
yeah.
say my house in the middle of Orlando would cost you $1.5 million, but where I am, it cost me what I told you, like
No,
$330,000.
you're right. It's money.
Orlando's an hour drive from here, so I could. This is another thing that I like to tell my audience: you don't always have to live in the middle of everything.
Right.
You don't need that condo in the high rise in the middle of a city. You can find a nice townhouse out on the outskirts that's more affordable and just take the Uber in or drive in if you need to and save that money for an investment instead.
That's right.
Because that's what's going to get you long-term wealth. And then when you get up there and you have your $5 or $10 million or whatever it is, then go buy your fun stuff if you want to. But by that time, your mentality has focused so much on your investments that you're not going to do that just because you're going to be like, I don't need it. No, I want to make another $100,000 instead on my stock portfolio or whatever, new business purchase or real estate purchase or whatever. That's how it's going to go. I am like that myself at this point.
That's exactly how it's going to go. You're dead
Yeah.
on.
Yeah. For someone listening who's about to buy their first home or maybe considering downsizing in Central Florida, what financial steps should they take before making that move?
The first thing they should do is a financial plan. And I mean like a full blown plan where you sit down with someone and put all your assets, all your investments, all your projected income. So you actually have a 10-year visibility of where you're at and where you expect to be at, and then be conservative on the expectations of that. And then that will start setting the tone of, okay, then which house should we be buying? And it'll be less than what a real estate broker is going to say you can afford.
Yeah, for sure. For sure. One of the most powerful parts of your message is diversification beyond just investments. How does real estate complement other asset classes like retirement accounts and liquid savings? And I want to add something to this question as well. I have recently interviewed a gentleman. It hasn't aired yet. It's going to air soon about land banking and how you could convert your Roth into a purchase that could 3 or 7 times itself by purchasing land in developing areas. So there's those ways as well. But how do you see this happening?
I see it as a critical wealth building tool. An investment is a real estate is a very probably the number one way people build wealth. Okay. And the reason, I just want to make sure people understand the reason for that. It's because of leverage. Okay. It's not that real estate goes up more than the S&P 500 as an example, right? If you were to go and invest in the stock market and go invest in the real estate and you were to pay cash for both, they would be very similar. The reason real estate is so enticing for investors is because they can leverage it. They can go put 20% down and buy $1 million property. And so they take a $200,000, buy $1 million property. If that property goes up to $1.2 million, they didn't make 200,000. They just doubled their money. Where if you do that with investments in the brokerage business, it's one for one for the most part. You can margin money, but it's very dangerous. So it's important to understand that concept, first of all. That's why people do real estate. But if you do, that means it's also more risky. And that's why you hear people that'll go broke and go through real estate. So I'm totally for real estate as an investment. It's a fantastic way to build wealth, but it goes back to making sure you understand what's the carrying costs of that real estate and what happens kind of worst case, best case scenario, and build that into your strategy. Because I've seen a lot of fortunes, either one removed or people that I don't know, but they're people that I know that have lost fortunes in real estate. And what they basically did is they just didn't build in enough margin for a 2008 or a 2001 or even 2011, 12 when things slowed down a little bit.
And also, you're not talking about buying real estate for yourself to live in. We're talking about real estate investments
That's
that
right.
generate you money.
That's right.
It's about buying a commercial property that has three shops in it and they're all rented out and they're making you money, or buying a 10-unit multifamily that generate you rental income, or as I mentioned, buying a piece of land that will eventually be converted into a commercial lot and then you can make some extra money there. But that's not generating everyday income. It's just future plans. But these are the things we're talking about here. We're not talking about, hey, I'm going to buy another house for myself and then I'll have a second home and by the ocean.
Exactly. I agree.
That doesn't make
I
any
agree
sense.
100%. That exactly. So it's a very good way to build wealth outside your personal residence. Buy real estate as an investment, not as I think I'll just buy $1 million home. No, buy a $400,000 home and invest 600 in real estate.
Correct, correct. And then, so retirement accounts like a 401k and a Roth IRA, could you transfer those funds into a purchase of a real estate? So let's say your 401k or my Roth, it does about 10% a year. Okay. I'm never going to make three, four times on it within a 10-year period. But if I move that money into a land purchase or a real estate purchase where I have cash flow and I have leverage, because it's going to be the down payment, it's not really going to be the purchase. Let's say not all the time, or is it supposed to be like that? You're the financial advisor, so let me know how that works.
You can do it. That you do have these self-directed IRA accounts that you can set up and invest in all kinds of things, including real estate with it. But here's the deal. You have to make sure that you have enough money that in that account to pay all the expenses. So you don't typically get the same return on that Roth IRA investment in real estate that you would in that real estate investment outside the Roth because the leverage is different. You can't leverage that, you can't get the level of leverage in that Roth IRA account because the only money you have to pay for that land has to come from that Roth. So let's say you have, I'll use an example. I have $100,000 in my Roth IRA and I want to go buy a piece of real estate that costs $500,000. Okay. If I take 80,000 of my Roth IRA and put it as my down payment, I only have $20,000 left. If all of a sudden there's a bunch of people move out, there's a slowdown in real estate, there's a storm and you need a new building that's a new roof that's $100,000, you can't, you can only pull the money to pay for that real estate from that Roth.
Oh, wow. I didn't know that. You can't put in money from your other.
No. Now, I
Uh-huh.
don't know if you can do like a partial, but I actually just got off a phone call with someone because I did find a piece of flat land where
Yeah.
I talked to one of those IRA, self-directed IRAs, and he went through those details. You'd actually want to talk to one of those custodians. You can call them, but it's very expensive, and it's also not as it's not as enticing as it sounds, is the best way I can word it, because you're not getting the same leverage. It's not one for one. So if you're going to go buy $100,000 piece of property from your Roth IRA, that's fine. You just take 100 grand from your Roth IRA and buy the property, but you have to have enough money to pay for the taxes and some of that stuff from your Roth
Gotcha,
IRA, right?
gotcha.
You can't go get loans against it and can't, there's no leverage attached to it. There would be outside that Roth IRA.
So if my Roth IRA holds a rental in it, the rental income has to go back into the Roth IRA.
Absolutely.
Got you, got you. So they basically
100% of it. And if it's not, goes back in, they get audited and that's how you get in trouble. And all of a sudden, if you start messing around with that and you're, oh, this is this, and you get audited and they discount it, all of a sudden they can discount the whole, they can void the whole thing. And then you
the
just end up with a massive tax bill.
got you. And could you partner up with your Roth IRA and 50-50?
I
Like,
don't know the answer to that. That's the piece I don't know the answer. I'd have to talk to.
'cause that
We'd
could
have
be a
to,
solution to the fixing and all that stuff.
exactly.
But you're limited about how much money you can put in a Roth IRA per year. Like you have to have multiple years under your belt to reach the amount so you could purchase a home with it.
I don't know if you can do the 50-50. I'll actually have to research that. But I don't do it because I do the brokerage side of it. So I'm
Uh-huh.
mostly on the investments, stocks, bonds, listed types of investments. Even in the real estate business, I do put a portion of every client's assets in real estate if they don't have real estate outside their house. So part of the asset allocation I do, I'll use REITs and investments that are exchange traded.
Got you. Got you. I
But
mean,
I
this was
don't, but I don't do the self-directed IRAs piece. You'd have to talk to one of the custodians to do it.
okay. I might have to interview one. I can
That'd
help you
actually
out.
be a really good interview.
Yeah, because there's so many options out there, and it's just insane how much the government wants you to buy properties. And
Correct.
they've proven that over and over again about how much tax benefits you get by buying property. You can write off your interest, you can write off your expenses, you can depreciate the property. There's just so much things that go into a property deal that a lot of people don't understand. And I keep saying that to my investors that are cash, to go just buy cash. I'm like, why? Leverage it. You could use that leverage. You could buy two instead of one. You can, if you buy the right type of property, I'm saying that generates enough cash flow and all that. You have to do your numbers, but you could buy two, let's say, instead of one, or three, maybe even if you have that kind of money and that has cash flow in it that comes out. You could depreciate it. You could write off the interest. You could do so many things with it that they don't take into calculation when they're looking at an investment property purchase. And we're here to educate them on that, I think, and to
Yeah,
get them
no,
in the right
and it's
shape.
leverage is the key.
Yeah,
You're getting leverage. But
leverage.
but I have seen fortunes lost not because it was a bad investment, is they just didn't have enough money to maintain the cash flow, the carrying cost of a property. That's what's so enticing to a piece of just a vacant lot. The carrying cost is nothing, right? It's the taxes on it. So
Yeah,
if you go spend money on a vacant lot, no matter what happens to the market, you might have to wait 3 years or 5 years or 10 years for the market to come back, but it's going to come back. You'll still own the asset. Where if you go and leverage a apartment complex with 3 or 4 units, and all of a sudden there's a 2008 and you have it 80% leverage and three of those people move out, or you forgot to use COVID, the most recent, where those people just quit paying rent and said, I don't have to pay rent.
yeah, that's a big one.
Do you see what I mean? And all of a sudden, you're just standing there with this $500,000 property. Can you cash flow it during rough times?
Or
And
can you pay the payments on it during rough times?
yeah,
The
exactly.
asset until things get figured out.
Turn
We
around
we
because
got
things
lucky
will
here in
always
Florida.
turn around, right?
Yeah,
I
I
mean,
know. We got really lucky here in Florida and during COVID because we were locked down for 3 months and then reopened. So we were luckier than most other states in the
that's
country
right.
in that matter because people could go back to work after
Yeah.
3 months of lockdown. So you basically had to carry for 3 months. Most people had one more month in them, and then we got all the packages coming from Washington and everywhere to help support to pay rent. So now your landlord, you're getting money from the government for the tenant, so he can stay in the unit. You're not kicking them out. And it was a lot of good stuff came out of it, but a lot of bad things too.
Yeah.
Um,
But real estate, to summarize, is a very important part of building wealth and can be, but it needs to be thought through and it needs to be included in something, your overall plan. It's not the only asset you want to have, but it's a really good asset to have.
yeah. So you've worked with high net worth families for decades. What patterns have you seen in the people who succeed at building and keeping wealth? And what mistakes do you see over and over that our listeners can avoid?
We've hit on a lot of them. They separate the money. High net worth people, I kind of re answer the question what we talked about. They see their investments and their living expenses separately. They don't merge the two. So they don't look at their investments and say, I made $200,000. I can go buy a $50,000 car. They don't care. It's completely disconnected. Their investment, their investments are disconnected from their living expenses.
Got you. So that's like the biggest thing.
Single biggest thing. And now that I bring that up, you will see exactly what I'm talking about. I guarantee you. And when you're out talking, you have a real estate person come in. When you're going out driving, taking someone to go see real estate, you will see exactly what I'm talking about. People with money, they separate those two.
It's a good way to identify them.
Yeah, no, you will. And it drives my wife absolutely crazy because if I'm at something, I'll say that person has a ton of money and or that person doesn't. She's like, who cares? I say, I don't care. I'm just pointing it out, but I can tell because of how they view money.
Yeah,
It, it
how they use it and how they view it. Of course, that makes a lot
exactly.
of sense. It's like the blue jean millionaire, I usually call it. It's my avatar is a blue jean millionaire. The
No,
person that's down to earth, knows what he's doing with his money, has assets, and he has investments, and he's not easy to fool. The
that's
person
right.
that, down to earth, the blue jean millionaire, he's not wearing a suit, driving a Maserati around town or a Ferrari to show off and bling. He's the guy that comes with let's say a Toyota Corolla, but he has millions of dollars in the bank.
Correct.
You
There was
get
an
what I'm
old book
saying?
written back in the 80s called Millionaire Next Door. So it's the same concept that you're talking about.
Yeah.
But they're not like hiding their wealth. It's important to understand that, and again, it goes to a mindset. It's not that when you talk about like a blue jean millionaire, or you talk about millionaire next door, someone who's worth two, three, $4 million, but they don't really live like they are. It's not that they're hiding their wealth. It's just how they see money. That's it's ingrained in them. Like they just don't see their investments as their living money. Those two are separated. Now they'll take $10,000 a month out of my investments and put them in my checking account. Now that 10,000 becomes my living expenses. That's fine, but that's kind of part of the plan. They don't say, "Oh, I'm going to take 50 this year and go buy this month and go buy X." They just don't.
Yeah.
They don't see it like
They
that.
think over that purchase multiple times before they make any moves, or if they even make a move.
Yeah, because they're living on 10,000 a month.
Yeah,
They're
exactly.
literally
This is my
they're
budget. That's it.
this is my budget. It's not, they don't go say I'm worth 2 million or 5 million. It's we can live on 2 million or we live on 10,000 or $15,000.
Correct, correct. At what point should someone bring in a professional counsel like yourself before buying, before selling, or only when they're making a big move like retirement?
I'm gonna do this in 2 minutes, but I'm gonna kind of give it of the three: have a plan, be diversified, seek counsel. So think of have a plan, be diversified. Those are really objective. If you sit down with 10 financial advisors, you're gonna get nine are gonna be almost identical. Okay. When you get to the third, seek counsel, that is the hardest of all. And that's really the difference between the top 3% of net worth people and the 97%. Because what happens is 80% of millionaires in America are self made. 80%.
Yeah,
Okay. Now, here's what happens if you're one of those 80% self-made millionaires and now all of a sudden you're 40, so you're still under 40, but now you're 45, right? And you've never sat down with a financial advisor, you've gotten there on your own. Now sitting down with a financial advisor or getting advice or getting input is almost foreign to you. Okay, you actually have to learn it. It's a skill set. Okay. So, what I want to encourage people to do is don't think of seeking advice as sitting down with someone like me. Think of seeking advice as something you always do. And the bigger the financial decision is, the more input you get. And you're not asking for advice or input, you're asking for input. But what you're really looking for is best case, worst case scenario, and make sure you don't have confirmation bias, meaning you're not just looking at what happens if this is a really good thing. You're looking for people to give you advice or suggestions or input that you might miss. And if you will do that over the course of 7 or 8 or 10 years, all of a sudden you'll get really good at making financial decisions because you'll be used to seeking out 5 or 6 or 7 points of input, right? Because you could even use like AI for that today.
yeah,
But that's still like one piece that you would put into your data points. You'd want to ask 5, 6, 7 people, right? So if I'm going to do real estate, I might call you up and say, Lancelot, what do you see about rental properties in Daytona Beach? And then you'll go through and you'll give me the whole works. And then I might call someone else and say the same thing. And then I might actually go on the internet and look. But I might talk to 8 or 9 people before I even come back. And then I might come back to you because I liked your personality or I liked something. But you may just be part of my 10 touches.
got you. So that makes a lot of sense. Make sure that you.
So
Uh,
Exactly. So the question, back to answer the question, is when should they sit down with someone like me? They may not need to. If it's your first house and you know what your budget is, just if you under budget, but that doesn't mean you still don't ask or start building that that engagement where you're asking a lot of for input. Get used to asking for input because that's a very common skill set that people that have a lot of money use.
Also, if Tim likes to play golf, you could ask him to go and play a round of golf with you.
Yeah, exactly. But I'm just telling you, it's really
Yeah.
fascinating. Of all the people that you know,
When you're at that caliber,
engage
that's
with,
what I meant, Tim. When you're at that caliber, it's like you're learning from each other
yeah,
a lot of
exactly.
times. So, hey, you let's go play a round of golf. I have some ideas that I want to shoot by you. Maybe you have some stuff you want to ask me, and maybe we
But
can put something together on this.
so I'll give you an example. And I don't mean this to be politics at all. I mean sincerely. So please don't take this as politics. So just take it as a takeaway, but it's a really good example. Like the best example I've ever seen. So Ivanka Trump was interviewed on the Lex Friedman
Yeah,
podcast, right? So
that's a
Lex
good one.
he does exactly, and he does like a 3 hour interview.
Yeah.
Okay. So it's a really long interview. All right. Now I'm watching this interview just off on the side, right? And somewhere in the middle of it, I knew it immediately. I actually taped it. I was like, oh my gosh, that's the answer. He says, he goes, so Ivanka, what's the number one lesson you learned from your dad? Okay. And she, with no quote, I don't mean like it wasn't like she had to think about it. There was no pause. There was nothing. She said, be curious. Immediate. Okay.
Yeah.
And he goes, what do you mean by that? And he goes, well, I'll give you an example. She goes, I was my first executive in Trump organization. So by now she's like 32, 33, 34 years old. And she goes, my first job was to convert the post office we bought into apartments in New York. Okay. And she goes, and I was very stressed about this. It was like there was a bunch of stuff going on. But one of the things that we were really struggling with was the atrium. So this post office had this atrium in the middle. And they said we were really trying to keep that atrium at 70 degrees. So if it was 30 degrees outside, it was 70 in here. If it was 90 degrees, it was 70 in here. And she goes, it was almost like breaking the bank and making the project not financially doable. Okay. And we had all kinds of engineers. And so everyone knew that this was a big problem. And she goes, my dad comes and does the first walkthrough. Okay. And she goes, and I was nervous. It was my first executive role taking this thing. And he goes, okay, let's take a tour of the property, right? And they knew they were dealing with this thing. And all of a sudden, Trump goes up and starts talking. And she even says, she goes, seriously, she goes, all of a sudden he starts talking to the guy putting the air vents in. And she goes, the first guy, I don't know. And he goes, what do you think about our air conditioned heating system in the atrium? And the guy didn't have it. She goes, he didn't say anything. And then he's walking along and he sees another one. He asks him, and she goes, he gets to about the fifth one. And the guy looks at him and says, you want me to be honest? And Ivanka starts laughing, and you can go watch this
Yeah.
on Lex Freeman. I'm almost like quote for quote. And he goes, yeah, and he goes, you're over engineering it. He goes, it's not 30 degrees very often, and it's not 90 degrees very often. And he goes, you're spending 2 times more money to make that 1 or 2 degrees. He goes, and I'm not even sure it's going to work. He goes, back it off. And now these are the linemen. These are normal people.
Yeah. Yeah.
My point is in seeking counsel does not mean just smart people or rich people or something. It means people who are doing the job. It's getting input and getting used to it. It's that curiosity. And I was like, man, that is just fascinating because again, it's like that's the perfect example. And it's not that they didn't know that they probably needed to talk to engineers and all that, but it was just confirmation that they were overthinking it.
That is awesome. That's a great lesson learned there. Just seek advice from whoever you can. Be curious.
Be curious, and all of a sudden you will be shocked how you will make better financial decisions if you don't just think of, okay, I got to seek advice from someone higher than me, or no, if you're going to move to Margaritaville, go talk to the salesperson, but when you're out driving around, talk to the people living there,
Always. And I've noticed that a lot of times when I take my wealthier clients out or my investors. Investors are like hawks. They talk to everybody.
That's
Boom,
right. Because
boom.
that
Neighbor,
is,
tenant, anybody
yes.
around, handyman on site. Boom. They grab everybody and they talk to everybody for at least 5 to 10 minutes. Ask them a few questions because whoever they can talk to, the more knowledge they get about the property, the better for them to make a decision of how they're going to structure their offer if they're going to
That's
structure
right.
it at all. That's the thing. And finally, Tim, this is my last question. If you could leave our listeners with one piece of financial wisdom for building long-term wealth through real estate, it would be what?
Just be patient and do it exactly what you said, long term. And don't think in terms of not in the next year, think in terms of the next decade, the next 2 decades. Don't think in terms of the next year or two when you're doing any type of investment. Think of that investment as a decade, 2 decades.
Awesome. Thank you for that advice. Timothy Clifford just gave us a roadmap for not only buying or selling a home, but for protecting wealth across a lifetime. If today's episode resonated with you, go check out Timothy's book and resources at planassist.com/book and follow him on LinkedIn, YouTube, and X under My Plan Assist. And don't forget, if you're looking to buy, sell, or invest in Central Florida, my team at the Sir Lancelot Group and Florida Homes Realty and Mortgage is here to guide you. Make sure to subscribe, leave a review, and share this episode with someone who needs to hear it. Until next time, keep your vision big, your strategy smart, and your real estate moves legendary. Have a wonderful day, everybody. Thank you for joining us on Sir Lancelot's Real Estate Roundtable, where we've unveiled the mysteries of real estate together. Remember, in this kingdom of possibilities, every dream home is just a discussion away. I can help your real estate dreams come true. Just call me at 786-449-7518. Until our next roundtable, may your ventures be prosperous and your homes be filled with love and joy. Farewell, fellow knights of real estate.